So I hope you're doing well out there. Today we're going to talk about 3 UK dividend stocks for 2024. So quite often I get asked about talking about new stocks I would potentially buy right now, what are good opportunities in the market, and today we're going to focus on dividend stocks. And I came up with this idea because the other week, I actually got my legal and general dividend. And when it came in, I went, wow, that's a very big juicy dividend. And sometimes you forget how nice it is having some of these dividend stocks, that when you get that nice dividend payment come in, sometimes it shocks you and you go, that was a lot of money that kind of came in there. So I thought, let's talk about some opportunities that could be out there if you were looking for a new dividend stock now. Which are currently the best dividend stocks out there. Now, I have tried to look for dividend stocks that are paying over a 5% dividend yield, and that would be quite a nice dividend to receive. And the other thing I thought about is that this would be a really good time to do this video right now, because what are we going to see in the next coming 6-12 months? We're more than likely going to start seeing the interest rates cut. Now, if the interest rates are cut, all these people that have been getting that nice high interest rate that's 5% yield, risk-free, well, mostly risk-free. If that's not achievable now, and that is getting more towards a 4%, 3%, will people now be forced to go into some of these UK stocks that do have that higher dividend yield? That is where you are potentially going to achieve that higher return. And maybe there's a lot of people on the sidelines now within the next 6-12 months. They're going to be looking at a lot of these dividend stocks and going, I'm going to have to go buy in there now if I want to still achieve that, higher yield here. And as well as that, I've also picked some stocks that I believe would also have that share price appreciation as well. You don't want to get in a situation where you're having, oh yeah, I'm getting that 5% dividend yield, but your share price has gone down 10%, so you're actually worse off. I've also picked some stocks here that I believe the share price will perform quite well as receiving a good dividend yield as well. Anyway, enough talking, let's get started on these 3 UK dividend stocks. Now, like I said, this idea of this video did come from Legal and General when I did get their 8% dividend yield the other day. Actually, for me, it's a 9% dividend yield with the average I have. I was close to putting in today's video, it's an honourable mention. But before we get stuck on today's video, if you do want to see some more content from me, join Patreon. I do 2 exclusive videos a week on there, and I just dropped my UK portfolio review, so you can see all of my positions in the UK portfolio, all of my UK dividend stocks and how my stocks are performing. And as well as 2 exclusive videos a week, you get a Discord with 500 members on to talk about stocks, including me on there as well. £5 a month, the price of a pint, link is in the description if you want to support the channel. And as well as that, if you are looking to invest, the platform I use is Trading212. You can join through the link in the description as well, and you'll get a free share worth up to £100 through there. Now, let's get on to the first stock. So the first stock is Money Supermarket, and I think this is the one that, this list isn't in a particular order. However, if I was to put it in order, I would say that this would probably be my number 1 pick as well. I think this has some really big tailwinds that are going to come up in the next 12 months that are really going to help it. Now, it currently trades at 16 times earnings. I believe this stock should actually trade at 20 times earnings. I think it's a discount to the market, and it shouldn't be. This is a really good stock. And as well as that, you are getting that 5% yield that I talked about, but I think that dividend is going to get hiked up as well going forward. Now, the stock itself has been a little bit of a stock that hasn't performed that well since the whole CV situation. The stock lost about half its value. It did start having a bit of a rally up through 2022 into 2023, but recently it has been on another dip here, and I think this dip is giving you the chance to buy the stock at a discount while collecting a very high dividend yield. And just to put into context about the earnings ratio, so it's currently trading at 16 times earnings. If you do look at what the company normally trades at, it normally trades at 18.3 times earnings on the last 5 years basis, and the lowest it's been in the last 5 years is actually 16.4 times earnings. So it is the lowest PE it's ever traded at right now in the last 5 years. Now, Money Supermarket, as sure most of you guys will know, is a comparison site. So if you want to go and get car insurance, home insurance, broadband, the energy market, which has been taken away from this business, which we'll come back, which we'll talk about in a little bit. Basically, if you want to save money, you come to a comparison site and you try to get the best deal, and then Money Supermarket do take the cut from that. Now, straight away, the one negative that I always see people say about this is that it doesn't have a moat, and I disagree. Google entered the US and UK comparison sites. It tried to be a Money Supermarket and it failed. It shut down all of its services back in 2016. Now, if anybody was going to succeed in this kind of market, you would expect it to be Google. With the big share they have in search engines and all the data they have, you'd expect Google to be definitely a big player in this space. But it does show you it is quite a hard space to crack. And once you have those customers, they keep coming back and use you every year. The details are saved, you save your details, you keep comparing them. So I disagree. I think once you are tied into one of these details where all your details are saved, you carry on using them. And I think this is clear when you look at Google. Even Google struggled to kind of crack the whole comparison market, as you can see here. Now, at the moment, the big thing that's going up is motor insurance premiums. Insurance premiums are now catching up to all the inflation. They're a lot higher, and people are getting a little bit more sensitive around making sure they're getting the best deal out there. And that's done very well. And that's the history of the business. The history of the business is that when one of these parts of the business does well, it covers up for any of the parts that aren't doing well and keeps the company moving in the right direction. And we saw that plenty of times during the whole COVID situation. COVID stopped the travel insurance space, but other parts of the business made up for it. The likes of looking for car insurance, everyone was out buying new cars. Mobile phones, everyone was out buying mobile phones. After all that happened, travel came back. Travel insurance did really well. Now we're having home insurance doing really well. Now the big thing that's going to come back in the next 12 months, in my opinion, is the energy comparison side. So the company itself used to make a lot of money from the home services, the energy insurance, but what we had is the price cap situation where you are not allowed to have the energy comparison sites at the moment. Now, when that comes back, that's going to be, because it's all sitting there on the platform at the moment, but it's not being used. And if the home services part of the business comes back in the next 12 months, which I think it will do, that will help it massively. So if you look at the moment, for example, the end of this year, the home services contributed 39 million. Now, if you go back before the energy situation happened, which I've got here was 2019, before the whole CV situation, this was actually at 68 million. And also you got to think about the growth as well of the new clients that are going to be on the platform. So you can see here there's a massive gap on the revenue, and this is from 2019. Imagine where this is going to be now with the energy, the home services, with everybody desperate to compare the amount of clients that are now on the Money Supermarket platform. We have the potential for the home services, in my opinion, that's sleeping on what could be about 100 million contributor to the revenue here. And that will make a massive difference from where they are at 39 million. If you add another 60 million of revenue onto this company, and a lot of that will obviously go straight down to the profit because it's already there sitting for them, you then talk about a company that is going to look very cheap on an earnings point of view, and from a dividend yield, they'll have the potential to really hike up the dividend as well going forward. And when we do look at the past performance, you can see the dip that happened because of the whole CV situation, and then we start to have the company start to rebound, and we are now at a higher point of revenue and profit from where it was in 2020. And that's without the whole energy situation coming back. As soon as the energy situation comes back, I think we'll be talking about another 60 million at least added to that revenue point of view. Profitability wise, the profit margins will also go up. I think we'll be talking about 100 million in profitability. Once again, the company looks even cheaper, and what you'll have is once again a dividend that will be carried on and hiked up as well. And we'll talk about probably a 6% dividend yield in 2 or 3 years' time. So I think Money Supermarket looks very attractive at these sort of levels. Number 2, a stock that I've not talked about for a while. I do own this stock as well though, which is Cakebox. And for me personally, I'm actually really considering adding into my Cakebox position at the moment. Same again, the company I believe trades at a discount to what it should do, 15 times earnings. Now it does come under the category of a 5% yield, which was my target, but it's only below that target by 0.06%, which you can let me off for. And in fact, they are going to actually report earnings this week, and I believe that they will hike up their guidance, and I think that will actually take it up to a 5% dividend yield. And I think they report tomorrow, I believe it is. So this could go out of date really quickly, but I'm using the best information I have here. So yeah, it's only slightly under, and like I said, I think it will be above it very soon after the report earnings this week, but I'll just let you know about that. So Cakebox, they do a lot of these. They do also cupcakes, but the main thing is they do these cakes, and these are eggless cakes, which is their kind of main selling point. But if you have had one, you'll know how good they are. Now, most of the time, they actually come through these kind of stores here, which is on a lot of high streets in a lot of main cities, and they look really nice. They stand out on the high street. But the really big thing I like about Cakebox is these ones, these smaller little pop-up ones that you'll see sometimes, and I really like it when they open these up in the shopping centres. This is where I first heard about Cakebox. I think I first heard about Cakebox in 2020. I was going through the Trafford Centre and I saw one of these stands, people queuing quite a decent line for it, and I was like, what is this Cakebox? Like, the cakes look really good. The queue's really big, and as a typical Brit, I kind of joined the queue like, oh, we love a queue, I'm going to join the queue. And I had one, I was like, this is really good. That's when it first got my radar, and then I watched the company financially, and I was like, okay, this is really good. I feel like if they open up more of these stores, especially these kiosks, they've got one at the moment in the Arndale Centre in Manchester as well. I think if there's so much potential to open up these stores, even in supermarkets, but supermarkets, shopping centres, and then also have some of these main stores in the city as well. There's so much room for potential expansion. And like I said, it's hard to kind of say how good the product is until you actually go out and try one. I'd say that even before you invest, just go to one of the shops, try one of the cakes. They are really good. They're one of the best cakes I think I've ever had. The cakes are really soft. They're not, sometimes I feel like cakes can be, feel like they're a bit stale and they've gone a bit out of date. Maybe I'm just picking the wrong cakes, or maybe I'm leaving them too long in the cupboard, but always with cake box, I know that it's going to be, I'm not normally a big cake fan, but if I ever see a cake box when I'm walking about, I'm like, okay, I'm going to get a treat for later tonight. I'll have a tea or a coffee and have this cake, and they're really nice, really good. And you can see here from the reviews, 4.4 stars at the moment on Trustpilot. And I believe there's just so much room for expansion for them. They are starting to open up more and more stores. But even when I went on the website the other day, and I thought, York's such a big city, and yet there's no cake box in York. I'm just looking around here. I mean, the company is based in Birmingham, and you can tell that. I mean, look how strong they are in Birmingham and London. London and Birmingham are quite strong places for them. But if you just start going around, I mean, Exeter doesn't have any cake boxes down there. Just looking around here, Norwich, pretty big city. I think Norwich is a city, isn't it? Yes, Norwich is a city. Grimsby, it's a good job we're not a geography channel and we're a stock market channel. But you start going to Scotland as well. Aberdeen, there's potential there. Dundee. I mean, look at Scotland. I mean, I know there's not much normally past Glasgow and Edinburgh, but there's definitely enough room for a couple of cake boxes up there. You have the potential then to even push into Ireland, Republic of Ireland as well. A lot of expansion potential there. They're still really in the early stages of opening up venues. Not like a Greggs where you're like, can they squeeze one in between that street and get another Greggs in there? There's plenty of cities where there's still not even, or even towns as well, that there just isn't one yet that there's so much potential for. And like I said, it's a little bit undervalued from where it normally trades at. We look at the moment at the start of the video, and the company trades at 15 times earnings right now. And if you look at historically, the medium PE ratio for the cake box has been 21. So it's definitely a lot lower than where it has normally been at the moment. They did do a trading update on the 8th of April where they said they are expecting to grow 9% for the year, which is very good growth. Normally like that, a company growing that much, you don't trade at 15 times earnings with that dividend yield. And this is obviously in a year as well where, people have been really affected by the cost of spending. If they're doing these sort of numbers when everybody's been a bit tight on the numbers, imagine in a good financial year as well. But also shows you people prioritize cakes. If it's a birthday, people still go out and buy each other a birthday cake. They don't cut down on the birthdays, which is obviously just kind of shows the resilience in this kind of space here. However, like I said, we are going to get a update on the 11th of June, which is tomorrow. So just bear in mind that there's probably going to be a big movement after this video is actually out, to be fair. But yeah, the company is moving very well in the growth point of view. I would expect profit, even though Simple Wall Street have pulled that profit data for it, I would expect the profitability to start following the revenue as well at the moment. Financial health wise as well, it's a cracking business. There's 6% debt to equity on there. I mean, they can easily pay off that 1 million in debt. Cash wise, they're sitting on 7.5 million, so they can easily pay that off. And then as well, they can also focus on returning more cash to the shareholders, and that dividend will go up as well, which is quite nicely covered as well at the moment. Anyway, and that leads me on to the last one, which is Barratt Developments. Now, I always say if you are a UK investor, you do want to have, in my opinion, a UK house builder in your portfolio. I personally go for Barratt, but there's so many choices out there for house builders in the UK, whether it be, well, I'm going to say Red Row, but potentially Barratt are going to acquire them. Taylor Wimpey, for example. there's a lot of house builders out there that are available, and I would have one in your portfolio. Personally, for me, I have gone for Barratt Developments. Now, 23 times earnings, but that's a bit of a skewed earnings multiple at the moment because of what's going on in the interest rate and the housing market at the moment. 5.4% dividend yield at the moment, which is what they're currently paying. It is worth pointing out that Barratt Developments are looking to acquire Redrow. However, the regulator is looking at that, and we'll see if that does happen to go through. Barratt is saying that if that does happen, there'll be a lot of synergies and it will help them be more profitable. We'll see if that does happen, but I personally think that I think it will get blocked, but we'll see what happens here. Now, Barratt Developments, for me personally, I think are one of the better house builders. Whenever I go past the Barratt Development house, I always think there's a bit more personality there. I'm not a fan of new builds. I don't like them. I think there's a lack of personality, and I just don't like the designs. Sometimes I feel like they're thrown up a little bit cheaply. But I look at Barratt's and I always drive past them and go, you know what? If I were going to have a new house, this is one I would have. You know, I always think they've got a bit more personality. They're not all crammed together. They tried to take a little bit more of a care, a little bit. You know, all the sites are kind of different. You know, I always pass a Barratt Development site, and you can see there's a bit of personality between the houses. You know, every slide that we're going at here, I mean, just look, there's a little bit more personality to them to what you'd go past other sites. I drive past Persimmon sites. There's a Persimmon site that's down the road from me, and every house looks the same, and it's just a street, and it's like copy and paste of all the houses. And I feel like with Barratt Development, even looking down these slides, you can see there's a little bit more personality to them, and I think they're also a little bit better built. And when you look at Trustpilot, for example, it's very clear that's kind of a similar one. You know, for a new build that normally I get a lot of criticism, 4.4 stars is not too bad now. It's worth pointing out. I say this all the time, and then the one time I don't say it, I get it all typed in the comment section. But they're probably fudging the reviews and getting people to do good reviews to enter a £1,000 gift card or something like that. Yeah, I do say that all the time, and then the one time I don't say that, I'll get it in the comment section. So there's a lot of that does go on nowadays. It's like, leave us a good review and all that sort of stuff. But I've done this for a long time, and Barratt Developments, reviews have always been good when I've done these videos for like the last 6-7 years. It looks like a few of the house builders have caught onto them. For example, Persimmon's at 4.4, and they used to be like 1 star on Trustpilot. So I definitely think they've been trying to get them up a little bit. And I only hear negative things about Persimmon new builds. But anyway, this isn't supposed to be a video on the quality of what the new builds are like. Anyway, however, UK, we're short on houses. We need houses, and the thing is that when we look at the housing situation, all that's going to happen is the government are going to end up supporting a lot more UK house builders to kind of like go, we're short, you need to build more for us. And you look at the moment, we are supposed to have 300,000 new homes a year, and currently we're building less than 250,000, and that's just a problem that just needs to get filled. So they're going to be supported by the likes of the government, for example, but also what I said at the start of the video, with kind of the dividend yields, but the point of view is also on the house building areas that people aren't buying as many houses at the moment because interest rates are high. Now, in my opinion, we're going to soon see the UK cut their interest rate very soon, and it should carry on cutting for a little bit, not probably to the standards that we were in maybe 2020, 21, 2019. But I think we'll probably cut, to a 3 or 4% range. Now, if we cut to a 3 or 4% range, that's going to be a massive increase into the housing market. That's going to be felt very quickly, and people that have been desperate to move, maybe they've, families' size have increased, or they've got a little bit more money, or potentially that they are wanting to move area, or there's a lot of people on the chain that want to take that next step, or people that are looking to buy their houses for the first time, which a lot of people that are doing that, obviously a lot of them do prefer new builds, is that what that's going to do is that if they could see, my mortgage was going to be so-so, but if we move now, it's now £100 cheaper, it's £200 cheaper, and there's been that big build-up for the last 2 years with all these interest rates at these sort of levels, there's going to be a massive explosion of people wanting to buy houses. And I think as soon as we see that rate cut, I think we're going to see the housing market really start to hot up. And I think that we're very soon to that. And I think that that's where we'll start seeing the financials rapidly increase or improve in Barratt Developments. And I think that's going to happen very soon. And this is kind of the last point where I think you'll see Barratt Developments at these sort of levels. I mean, it's not as low as where we were, when Liz Truss came in and absolutely, car crashed the economy in the UK. We have had the recovery since then. We're up 27%, but we're still way off where we were even before the whole CV situation, for example, we're still at a very big discount to that point of view. And like I said, the profit is a little bit skewed at the moment because of what's going on with the interest rates, and we probably should start returning to more normality here, and then it doesn't look as high on the P ratio once that starts improving on the profitability point of view, and we start trading to more of historic averages that we normally trade at, and then we'll start seeing the revenue and profit start going up. House builder wise, for a balance sheet, it's a pretty decent balance sheet. 3% debt to equity there, as you can see. Pretty decent cash pile, I believe. 949 million at the moment. Dividend wise, they have had to cut the dividend because of the fall in the profitability. However, I don't think it'll be cut any more than this. I'm happy. I prefer them to cut the dividend because obviously, it keeps that balance sheet intact. You don't want them to keep paying out a dividend they can't afford. But what will happen as soon as that profitability starts going back up, we'll start seeing that dividend start increasing. And if it goes anywhere to the levels, close to the levels where it was at in 2018 or 2020, 2021, we're talking about where you potentially could be buying a 5% yield now, but then you probably might end up getting a 7-8% a year, which would be okay. From an insider point of view, it doesn't show that there's any insiders buying, but all three of these stocks, Money Supermarket, Cake Box and Barratt Developments, there was a lot of insider buying in the last not 12 months, but like in the last kind of 18-24 months. There has been insider buys that have just kind of gone off the radar, so as well as that, all three of these companies, there is insider buying going on, which is obviously another positive here as well. But anyway, that's the end of the video. So those are the 3 UK dividend stocks at the moment with around about 5% dividend yield, or maybe a little bit more, that I personally think are probably the better opportunities right now for dividend stocks if you were looking at any of them. So I hope you enjoyed the video. Hopefully there was some good information in there for you guys, and if you could, hit the like button, and if you're new around here and you did find the video helpful, make sure you subscribe as well. It's always nice to see when you spend a lot of hours making these videos. Apart from that, guys, I'll see you in a few days.